Understanding liquidity ratios, a comprehensive guide. Liquidity ratios serve as critical financial metrics that evaluate a company's capacity to meet its short-term financial obligations without the need for external financing. These ratios provide valuable insights into a firm's operational efficiency and financial stability, guiding stakeholders in their decision-making processes. This article will delve into liquidity ratios, their types, significance, advantages, drawbacks, and their context within broader financial metrics. What are liquidity ratios? Liquidity ratios are essential tools used to determine a company's short-term financial health by analyzing its current assets against its current liabilities. A company with a solid liquidity position has enough liquid assets to cover its short-term obligations, which lowers the risk of financial distress. Key takeaways about liquidity ratios. Functionality. Liquidity ratios assess a firm's ability to satisfy short-term debts without further borrowing. Common types. The most frequently used liquidity ratios include the current ratio, quick ratio, and days sales outstanding, DSO. Short versus long-term. Unlike solvency ratios, which evaluate long-term financial stability, liquidity ratios focus specifically on short-term obligations and cash flow. The importance of liquidity ratios. Liquidity ratios are pivotal in a company's financial health analysis, and their relevance extends to several stakeholders. Investors. By assessing a company's liquidity position, investors can gauge the risk of default, helping them make informed investment decisions. Creditors. Financial institutions leverage liquidity ratios to evaluate a borrower's creditworthiness and make decisions regarding loan approvals and terms. Analysts and management. Financial analysts use liquidity ratios to assess a company's performance, while management monitors them to optimize cash flow and operational efficiency. Regulatory bodies. These ratios play a role in regulatory oversight, ensuring organizations maintain sufficient liquidity levels to protect stakeholder interests. Types of liquidity ratios. 1. The current ratio. The current ratio compares a firm's current assets to its current liabilities. It reflects the company's ability to cover short-term obligations with available assets. Formula. Text, current ratio, equals \frac, text, current assets, text, current liabilities. A higher current ratio indicates a robust liquidity position. However, excessively high ratios may suggest inefficiency in asset utilization. 2. The quick ratio, acid test ratio. The quick ratio measures a company's ability to meet short-term obligations without relying on inventory sales. It provides a more conservative view of liquidity. Formula. Text, quick ratio, equals \frac, text, cash plus marketable securities plus accounts receivable, text, current liabilities. Alternatively. Text, quick ratio, equals \frac, text, current assets, text, inventory, text, prepaid expenses, text, current liabilities. 3. Days sales outstanding, DSO. DSO calculates the average time taken to collect payment after sales, providing insights into cash flow efficiency. Formula. Text, DSO, equals \frac, text, average accounts receivable, text, revenue per day. A high DSO may indicate collection issues, which can strain a company's liquidity position. Who uses liquidity ratios? Investors. Liquidity ratios help investors assess the short-term financial stability of potential investments, aiming to avoid defaults and to ensure the safety of capital. Creditors. Banks and other lending institutions rely on liquidity ratios to evaluate the likelihood of timely repayment from borrowers. A stronger liquidity position reduces the risk of defaults. Analysts. Financial analysts conduct comprehensive analyses using liquidity ratios to identify trends. These metrics help analysts understand the risks associated with a company's financial structure. Management. Company management uses liquidity ratios to monitor operational health, ensuring the organization maintains adequate liquidity for day-to-day operations. Regulators. Regulatory agencies may use liquidity ratios to assess compliance and ensure companies, particularly in the banking sector, maintain thresholds for adequate liquidity. Advantages and disadvantages of liquidity ratios. Advantages. 1. Simplicity. Liquidity ratios can be easily calculated and interpreted, making them accessible for decision-makers. 2. Quick overview. They offer a swift snapshot of a company's liquidity, guiding stakeholders quickly. 3. Benchmarking. These ratios facilitate comparisons between similar companies or industry averages, providing insights on competitive positioning. 4. Operational efficiency indicator. Changes in liquidity ratios can indicate shifts in operational performance and efficiency. Disadvantages. 1. Static overview. Liquidity ratios provide a snapshot at a specific time, ignoring the dynamic nature of cash flows and business operations. 2. Limited insight. Focusing solely on liquidity may overlook underlying profitability issues or long-term solvency concerns. 3. Varied industry standards. Different industries have different liquidity norms, making comparisons less effective across sectors. A closer look at liquidity ratios. Liquidity ratios must be analyzed in conjunction with other financial metrics, such as solvency and profitability ratios. This comprehensive view allows stakeholders to evaluate a company's overall financial health more effectively. Solvency ratios versus liquidity ratios. While liquidity ratios measure a company's ability to meet short-term obligations, solvency ratios analyze its long-term financial standing. Solvency ratios assess total assets against total liabilities, ensuring a company is sustainable in the long term. Profitability ratios versus liquidity ratios. Profitability ratios assess a firm's ability to generate profit relative to its revenue or assets. While high profitability is a positive sign, a company may still face liquidity issues that hinder its ability to operate efficiently. Example of using liquidity ratios. Let's consider two hypothetical companies, Liquids Incorporated and Solvents Company, in the industrial solvent sector. Liquids Inc. Current assets, $500 million. Current liabilities, $300 million. Quick assets, $400 million. Using the formulas provided. Current ratio, $500 million/$300 million equals 1.67. Quick ratio, $400 million/$300 million equals 1.33. Solvents Company. Current assets, $400 million. Current liabilities, $250 million. Quick assets, $200 million. Current ratio, $400 million/$250 million equals 1.6. Quick ratio, $200 million/$250 million equals 0.8. Comparing the two firms, while Liquids Incorporated maintains better liquidity metrics than Solvents Company, the quick ratio indicates that Solvents Company might face greater risk due to reliance on inventory. Conclusion. Liquidity ratios provide critical insights into a company's ability to navigate short-term financial challenges. They help safeguard investor interests, guide lending decisions, and enable effective management of corporate finances. However, stakeholders should also consider these ratios in context with other financial metrics to make well-rounded assessments of a company's health. As seen in the comparative example, while Liquids Incorporated may exhibit stronger liquidity, it is crucial to keep a comprehensive view of the industry and operational strategies to assess true financial health. Understanding liquidity ratios is essential for both novice and experienced investors interested in the fiscal dynamics of businesses.